Today, I'm joined again by John Ulzheimer, one of the top experts on credit reporting and identity theft. With over 33 years inside the industry, he's worked for giants like Equifax and FICO. He brings a unique insider perspective that few others have. John, thank you so much for being here.
My pleasure, John. Thank you for having me as always.
And as we did last time, we're going to go over some questions that we've received on social media from readers and just from the credit scoring space in general. And I'm ready to go through them if you are.
Let's go. Let's jump right in.
Okay, our first question is, how long will a late payment or missed payment hurt my credit score? I think we all know about how long they stay on credit reports, but how long can you expect your credit score to be damaged?
Yeah, the Fair Credit Reporting Act allows stuff like that to remain on your credit reports for up to 7 years, even though the credit bureaus, as a matter of long-standing practice, will delete them at 6 years and 9 months. They won't run them right up to 7 years. I don't think most people know that. Well, number one, whether or not it will hurt your credit score it's not a definite one way or the other. You can have a late payment on your credit report and it may lower your credit score. You can have a late payment on your credit report and it may not lower your credit score. I'll give you a great example. If you have FICO 830, which is an elite credit score, and all of a sudden a late payment hits your credit report, yes, you can bet the farm that it's going to have some sort of a triple negative impact on your FICO score. If you have FICO 580, which means your credit report is probably already polluted with negative information, adding another late payment is likely immaterial and probably will not have any measurable impact on your score. So things like late payments don't have a fixed value, meaning that all late payments aren't worth X points to your score. So it may or may not. Now, the how long question is also going to vary consumer to consumer. If there was no impact at all, then obviously it's not going to last for any period of time because there is no impact. If there is an impact, generally speaking, and obviously there's going to be exceptions to what I'm about to say, that normally if a late payment or anything else that hits your credit report that is considered negative, that harms your score, the impact of that item is going to wane over time. And unless you keep adding new negative information, the impact of this negative late payment is going to get over. Well, first off, the late payment is going to get older and older and older and older relative to the current date. And as it gets older, it's going to lose value in your score. So your score will go up organically just simply because that particular late payment is getting older. Again, unless you keep on re-adding new late payments to replace the older late payments, then your scores are going to be perpetually low. And that's obviously not a cycle that you want to get into. But it is not uncommon for your credit score to begin recovering from a late payment within 12 months. And as it starts hitting those milestones, 12, 24, 36, then your score is going to continue to go up, assuming nothing else changes. And after a few years, you're going to recoup a large portion of those points, depending on where your score started from. So I'm going to go back to my FICO 830 example. Your score will never recover to FICO 830 as long as that late payment is on the credit report, because that's such a high score and you need to earn every possible point in order to recover to that score. If you were FICO 620 and that late payment hit your credit report, you may recover to 620 much sooner because it's a lower bar and it's a much easier score to achieve. Now, obviously, if you were to get that late payment removed from your credit report because maybe, for example, it was incorrect and you were able to challenge it using the credit bureau's investigation process, your score is going to recover immediately because credit scoring systems do not have any sort of a memory. They don't know what used to be on your credit report. They're only going to consider what is currently on your report. So if you're able to get it removed, then your score may recover, within a month, 2 months, however long it takes for it to be removed from the credit report.
Okay, and just for clarification, we're not talking about, paying a couple days late. We're talking about 30 plus days, correct?
Yeah, there's a difference between a late payment on a loan or a credit card versus a late payment showing up on a credit report. In the credit reporting world, a rule that has existed for decades is that your initial late payment on anything has to be a full 30 days past the due date for it to be reportable to a credit bureau. There is no such thing on your credit report 1 to 29 days late. So
Right.
if you look at your credit report and if it does have late payments, none of those are 1 to 29 days late. They're all at least 30 days late. So you have this kind of built-in grace period, if you will, that the credit reporting industry has given to the consumer, that gives them actually a full month after the due date before the furnisher or the creditor, in my world, those are formally referred to as furnishers, can report that late payment to a credit bureau. Now, if you're 1 day late on your credit card statement, you're late and you may get hit with a late fee. The credit card issuer may start calling you, reminding you that you have to make a payment, but that's different than how long they have to report it to a credit bureau. 30 days is the minimum requirement.
Well, that's good to know, and it's also good to know that, you know, you make a late payment and then you just start making payments again on time, and eventually it'll lessen that damage.
Now, one more thing on that, John. One of the things that consumers get a little confused about is that it doesn't mean that every single one of the crescendo of late payments has to be 30. So if you go 30 days late, then when you hit 60 days late, that can be reported immediately. It doesn't have to be another 30 days. And then it's another, you don't get this built-in grace period for every single late payment if you've just stopped making your payments altogether on a loan or a credit card. Once you hit 30 days, they can start reporting you as late. And then the next month, they can report you as 60. Then the next month, they can report you as 90, et cetera, et cetera. You only get that 1 to 29 day grace period in the first late payment for any particular obligation.
And that's a good distinction to make. Our next question is, why do my credit scores look different depending on where I check them?
Yeah, so super good question. And in the U.S. credit environment, in the credit market in the United States, there are two generally used brands of credit scores: FICO, which is my former employer, and VantageScore, which is a creation of the credit reporting agencies. And then actually, I was a contractor for VantageScore for a very long time. So a business relationship, or had a business relationship with both companies for, collectively about 16 years. They're not the same thing, right? They're both credit scores. They're both credit bureau based scores, meaning that they're determined based on the information on your credit report, but they are two entirely different things, right? Think Pepsi, think Coke. Now, underneath the FICO brand, which is still the most commonly used credit score in the US and in Canadian credit markets, there are dozens and dozens and dozens of different FICO scores. And so here's the analogy that I use, and it makes a whole lot of sense when I use this. Let's say you're at the grocery store and you get to the cereal aisle and you walk down the cereal aisle, and you know how long the cereal aisle is. It's really, really long. And there are literally dozens and dozens of different types of cereal made by different companies. The one thing they all have in common, they're all cereal, but they're not the same thing. So think of the credit score aisle at the grocery store. And when you walk down the credit score aisle, you can see a ton of credit scores, and they're all different, but they're all credit scores. So that's how it is in the US credit market. People hear FICO and they think my FICO score is this, or my Vantage score is this, when in reality is you have dozens of credit scores, and there's no guarantee they're all going to be the same because they're all different. There's no guarantee that they're going to be the same for any specific period of time because your credit reports go through a series of changes every single month. And so just because your FICO score from Experian may be a 750 today, it doesn't mean that your FICO score from Experian is going to be a 750 tomorrow, or that your FICO score from Equifax or TransUnion is going to be the same as your FICO score from Experian. So that's one of the things that I think consumers have a hard time wrapping their head around, is that I've been reading articles about credit scores for decades. And one of the things that I think a lot of them fail to point out is that just because you may see references to your score is this, in reality, that's a little bit misleading, because no one has a score. We all have dozens of scores built by multiple companies, and they're not all the same. And there's no guarantee they're going to be the same, because they're designed to predict slightly different things. And so you would not expect them to be the same. So I'll give you, so the FICO score that American Express is going to get may be different than the FICO score that Chase's auto loan division is going to get, because it's two entirely different products, right? A credit card versus a car loan. They're both extensions of credit, but they're certainly not the same. One is secured, one is unsecured. One may be for 50, 60, $70,000, or one may be for a $10,000 credit limit. So they're very, very different things. And so the scoring systems that are used to predict the likelihood of you making payments on those two different things are going to be different because they're designed to predict different things.
Well, I really like the cereal aisle analogy. And one day I'm going to explain it to my kids that way because there are a lot of options and we can never seem to choose right when we go there. So
It's easy for people to understand the serial
yeah,
analogy.
absolutely. Our next question is, what is the difference between a charge off and a collection on your credit report? And I'm assuming that means what the actual difference is and what the difference is in your score and how it affects that.
So there are similarities and there are differences between a charge off and a collection. First off, you don't want either of them on your credit report because neither of them are good, right? If you had to identify kind of a collection of negative things, then both charge offs and collections would be part of that list of negative information. There are a lot of other things, but certainly charge offs and collections are going to be in that bucket of bad things. So a charge off is, for those of you who are accountants, you probably know what a charge off is because a charge off is an accounting designation. The longer formal term is charged off to profit and loss. And so essentially what it means is that the creditor has concluded that they're not going to be paid for the obligation and they are going to take it as a loss. They're going to write it off on their books as a loss. The industry, the credit industry or the credit reporting industry has long referred to that as simply a charge off. And so that's what a charge off is. Essentially a message from the creditor to the credit bureaus indicating we feel that this consumer is unlikely to pay this obligation. So we have charged off the debt on our books, essentially as an accounting designation. A collection is something very different. Normally, when people think of collections, they think of collection agencies, and rightfully so, because collection agencies, when they do credit report information, they are credit reporting collection accounts or collection segments, as they're called in my world. And so, what a collection is, and a charge off, believe it or not, a charge off can lead to a collection. So, a collection is an account on a credit report that has either been consigned by a creditor or perhaps the debt collector has purchased that defaulted debt from for example, a medical service provider or a credit card issuer, and now they're reporting it as being a collection on the credit report. A collection it indicates that the account has gone into default and now the creditor is taking escalated steps to attempt to recover their money. And rather than, say, for example, the doctor's office calling you or the apartment complex calling you, or eventually the credit card issuer is going to give up calling you, they're just going to outsource that to a professional that actually is tasked with collecting defaulted debts. And that is the collection agency. And so the collection agency reports collection accounts. And so those are the differences structurally between a charge off and a collection. Where they are similar, number one, is that they can both remain on a credit report for 7 years. And number two, they're both considered major derogatory or severe derogatory events in credit scoring systems because they both indicate gross mismanagement of some sort of an obligation, whether it be a credit card account, an auto loan, a medical bill, or an apartment lease, for example.
And I think it's important, the connection you made earlier about a charge off leading to a collection, because the charge off is not the end of it. They're not always saying, hey, this debt is, no longer going to be paid, but we can sell it to a collections agency that is going to get it paid. So do those often, one leads to the other most of the time?
Certainly. It's unusual that you have a collection without some sort of a preceding default event, right? Default on an apartment lease, default on a medical obligation, default on a credit card account. And then it leads to, assuming that the consumer just flat out refuses to pay their bill, that's generally when it leads to either the consignment of the debt or the assignment of the debt to a third-party debt collector, where the original creditor still owns the debt. They're just basically saying, hey, look, collection agency, I'll give you 30 or 40% of whatever you can collect, and that's my fee that I'm going to pay you. Or they may bundle all those debts together and sell them for 10 cents on the dollar to a debt buyer, and then the debt buyer then partners with the collection agency to collect the debts because they're now the new creditor. So it just indicates gross mismanagement of an account. Generally, it also indicates that the original creditor has charged off the debt because they feel like they're not going to get paid, and they're going to wash their hands of it one way or the other. They're either going to assign it to a collection agency to try to collect it, or they're just going to sell the debt and move on.
And also, it's important to note that there are lots of communications before it ever gets to that point.
This should never, ever be a surprise, right?
No.
Unless you're just simply not answering your phone, not checking your mail, not checking your email, ignoring all the stuff all the notices of default. Here's what you can't ignore, right? Some creditors will assign a debt to a collection attorney, and the collection attorney in some scenarios will sue you.
Mhm.
And then the knock at the door is not from somebody delivering something from Amazon Prime. It's a process server. And the process server is going to hand you a subpoena or lawsuit paperwork, and quote unquote, you've been served, letting you know that, hey, this creditor has sued you because you have ignored them to the point where or you've left them no other option other than to sue you. You can ignore that, but then you're going to lose by default, and then you're going to end up with a default judgment. And that gives collectors different levels of power to essentially contact your employer and have them garnish your wages. So you're absolutely right, John. This is never ever a surprise, but and you should never ever let it get to the point where people are knocking at your door and handing you legal type of paperwork because you have defaulted on a debt. The creditor would much rather work with you way before it gets to that point than take that last step, which is to sue you. If you feel like you're getting to that point, call a creditor and let them know, and then they're probably going to shut your credit card account. But at the very least, you've opened up a line of dialogue with them. You can discuss things like different types of payment plans, maybe even a settlement type of scenario, and avoid all the nasty stuff that can happen down the road.
I think that's the best advice. Just don't let it get to that point.
Yep.
You got a lot of tools to work with. Our last question for today, it's on a lot of people's minds. A lot of people have heard about it. They've thought, hey, this is going to be great. But President Trump has proposed a 10% interest rate cap for 1 year. But how would a 10% interest rate cap potentially affect a consumer's debt? And would there be any other impacts that they could expect that they might not have thought of?
Yeah. So the president has thrown out a lot of ideas. Most of them have been around mortgages, the portable mortgage
Mhm.
interest rate, and then the 50-year mortgage, loan. And so recently the president threw out this idea or this, I don't know if it's a proposal or whatnot. I think it's a tweet. I don't know that I don't know that it's evolved. And I know Twitter isn't Twitter anymore, but people, if I say it's an X, they don't know what that means. So I don't think I've seen any sort of context around this idea of capping interest rates, but I'll tell you that a lot of really important people are talking about it. Let's just put
Mhm.
it that way. My phone blew up, my email blew up the morning it came out because every financial news outlet wanted to get comments and an understanding of how this could affect consumers. I like the creativity. The problem with a 10% cap on credit card interest rates is how the industry would react to something like that. So there's three things primarily that a credit card issuer utilizes to what's called subsidize their risk. And when I say risk, boy, I'm not kidding. If you
Mhm.
look at the percentage of defaults on credit card accounts, it is significantly higher than defaults on auto loans and mortgages. Okay. Which means that as a credit card issuer, the risk of your business is higher than the risk of an auto lender's business or a mortgage lender's business, primarily because if you default on those types of obligations, they're just going to come take your car or they're just going to come get the house. Well, there's nothing to come get if you default on a $10,000 credit card you can't come repossess dinner. They can't come repossess whatever you bought with the credit card. So they're going to eat it. They have to take a loss on that. There's nothing to come get. So because most credit cards are unsecured, I know there are secured cards, but most credit cards are unsecured. And certainly any credit card with a meaningful credit limit is an unsecured credit card, which means that there is no asset that's helping to protect the creditor. So if you look at the default rate, it's way higher for credit card issuers than for other types of creditors. Because of that, your interest rates are going to be higher, comparatively speaking, than interest rates on auto loans and mortgages. You can get an auto loan interest rate at 4 or 5%. You can get a mortgage around 6%. You can't get those types of interest rates on credit cards, even if you have FICO 850. That's not even an option. Depending on who you believe, John, the average interest rate on a general use credit card, like so your Visas and your MasterCards and your Discovers, think of credit cards that you can use anywhere. The interest rates on those, the average interest rate on those is somewhere between the high teens and in the low 20s. That's, as you can imagine, that's very high relative to any other type of kind of tier one or mainstream type of loan or credit you're going to take out. The reason it's so high is because it's a risky extension. So here's how credit card issuers subsidize that risk. Number one is that they charge higher interest rates for pretty much everybody. Okay. Even, the 0% rates, those are teaser rates and they're temporary. No one has a teaser rate permanently. That 0% is going to go to something else after 6 months or 12 months has expired. So even if you've got good credit, your interest rate on a credit card is going to be pretty high. So that's number one. The other way that is used to subsidize risk as a card issuer is a lower credit limit. So someone who's risky is going to get maybe a $1,000, $1,500 credit limit versus someone who is not risky, where they may get a $20,000 or $30,000 credit limit. So look at, for example, the credit limits that you may get at a Credit One bank, which is a subprime credit card issuer, versus say, an American Express or USAA or something you can get at Chase, where you can get a $30,000 or $40,000 credit limit if you've got good enough credit. So that's one of the ways they subsidize risk is the credit limit. If you take away one of those methods of subsidizing risk, which is what capping the interest rate at 10% will do, the credit card issuer is going to react accordingly. History, and it's not just me speculating, history has shown that this is what credit card issuers will do. They did it after the 08, 09 Great Depression or whatever recession meltdown, and they've done it over time. Okay. Generally, what happens is credit card issuers it's called the flight to quality. They will fly to quality cardholders, which means that they will lower the credit limits for consumers who do not have elite credit scores. They will close accounts for consumers who do not have elite credit scores, and they will not approve new account applications for consumers who do not have elite credit scores. So for people who have credit scores, say below 715, which is the average right now in the US, if 10% is the cap, those people will not get credit cards, and they will not, if they do get a credit card, it will not be a meaningful credit card, meaning you're not going to walk out of there with a $40,000 or $50,000 credit limit, which you may be able to do today. So I like the idea. The hypothesis to try to help consumers who are struggling with credit card debt is solid as a rock, and no one would argue that that's a bad idea. It's just if you think about the unintended consequence and how the industry would respond, and it's not just me saying this. I've seen interviews with CEOs of the mega banks, the big credit card issuers, and they're kind of echoing the same thing: is that you better have a stellar credit score if you want to keep your card, or if you want to be approved for a new card, because otherwise we can't do business with you if I can't subsidize the risk of doing business with you, and 10% caps my ability to subsidize the risk.
Yeah. Well, it sounds like we definitely need some more information before really knowing, but it sounds like if that happened, it would be kind of pulling on a thread.
Yep. And we don't know if, again, we're working from a tweet. We don't know if it's retroactive, meaning would it be 10% on existing debt? And we're talking hundreds of millions of credit cards that are currently in commercial circulation. Does that mean all of those cards now, their interest rate's going to be reduced to 10% for the next 12 months? Or does that mean that every new credit card going forward for 12 months will be capped at 10%? We don't know. There's no structure built around this idea yet. So you got people like me and people in the social media world kind of speculating as to what does this mean directionally.
Well, I guess we'll see. And maybe that's something that we can talk about next time if it actually happens.
I like the portable interest rate on a mortgage loan, though. I'm pulling for that one. That one gets my vote.
All right. Well, we'll see. Thanks again for joining us, and we'll talk to you next time.
Thanks, John. I appreciate it.